Warren Buffett, the Oracle of Omaha, is making headlines again, this time not for a massive investment, but for hoarding an unprecedented $325 billion in cash. That's right, Berkshire Hathaway now sits on the largest war chest ever held by a public company, surpassing the combined reserves of Apple, Microsoft, Google, Amazon, and Nvidia. But why is Buffett holding so much cash instead of making big moves? Is he preparing for a massive market correction, waiting for the perfect deal, or does he see something the rest of us don't? In this video, we'll dive deep into the real reasons behind Buffett's staggering cash reserves. We'll explore the economic warning signs, the hidden signals in market valuations, and how Buffett's legendary strategy could mean a seismic shift in the stock market. Stick around until the end, because this could be one of the most crucial investment insights you hear this year. Section 1. Berkshire's growing cash pile. Let's start with the numbers. Berkshire Hathaway's cash reserves have more than doubled in just over a year. Yes, doubled. To put this into perspective, in 2023, Buffett's firm was already sitting on a substantial sum, but now, the $325 billion reserve has reached historic proportions. This isn't just a casual decision, it's a strategic move. Berkshire has been quietly selling stocks, unloading over $100 billion in equities in just the first 9 months of 2024. Notably, Buffett has slashed his massive Apple stake by 2/3, a decision that shocked many investors. Apple has long been one of Buffett's favorite holdings, so why would he trim it down so drastically? Section 2. The market's sky-high valuations. One possible answer lies in the market's historic overvaluation. Buffett has always been a value investor, someone who buys stocks when they're undervalued and holds them for the long term. But today's stock market is far from a bargain. A crucial chart that value investors like Buffett use is the S&P 500 price-to-earnings PE ratio. Right now, that ratio stands at a staggering 30%, compared to its historical median of just 17.9%. That means investors are paying nearly 70% more per dollar of earnings than they normally would. Even more concerning, the PE ratio has ballooned by 50% since early 2022. When valuations get this high, history tells us that a correction or even a crash may not be far behind. Buffett has seen this pattern before, and he's positioning Berkshire to take advantage of it when the time comes. Section 3. The 3 reasons companies hoard cash. So why else would Buffett be piling up cash? In business, companies typically hold large reserves for one of 3 reasons: preparing for an economic downturn, waiting to make a massive acquisition, believing the market is overvalued and not worth buying into right now. Buffett's actions suggest a mix of all 3. Given his long history of warning about market bubbles, it's likely he sees an overvalued market. But Buffett also loves to swoop in when prices collapse. Remember the 2008 financial crisis? While others panicked, Berkshire used its cash reserves to inject billions into Goldman Sachs and Bank of America, deals that later earned Buffett's firm massive profits. Could he be setting up for a similar move in 2024 or 2025? Section 4. Buffett's investment philosophy. Be fearful when others are greedy. Buffett has long preached one simple philosophy: be fearful when others are greedy, and greedy when others are fearful. Right now, markets are euphoric. The S&P 500 and NASDAQ are hitting all-time highs. Retail investors are pouring into stocks. Artificial intelligence hype is driving speculative investments. Buffett, on the other hand, is doing the opposite. He's cutting his stock exposure and stacking cash, waiting for an opportunity when prices inevitably fall. He's not predicting an exact moment when a crash will happen, but he's preparing for when it does. Section 5. Cash as an insurance policy. Beyond investing opportunities, there's another reason Buffett loves cash: security. Buffett has always maintained that Berkshire Hathaway must remain financially bulletproof, even in the worst of times. This philosophy saved Berkshire in 2008 when it didn't need to borrow a single dollar to stay afloat, while other financial giants collapsed. Buffett recently reminded shareholders that Berkshire can handle financial disasters of a magnitude beyond any heretofore experienced. That's a bold statement, and it tells us just how seriously Buffett is taking the current economic environment. Section 6. The warning signs Buffett sees. Let's recap some of the signals Buffett may be reacting to. Extreme market valuations. The S&P's PE ratio is dangerously high. Massive stock sales. Berkshire has offloaded over $1 billion in stocks. Economic uncertainty. Interest rates are rising, inflation remains unpredictable, and global tensions continue to escalate. Historical patterns. Every time market valuations have hit these levels, a major correction has followed. If Buffett is taking precautions, should you? Conclusion. What investors should do now. So, what does this mean for you as an investor? Should you follow Buffett's lead and hold more cash? Or should you stay the course in the stock market? While no one can predict the future, history suggests that caution is warranted. That doesn't mean selling everything, but it does mean being strategic. Buffett isn't exiting the market entirely, he's just waiting for the right opportunities. Smart investors might consider doing the same, holding on to high-quality stocks, being patient, and keeping an eye on valuations. At the end of the day, Buffett's actions tell us one thing loud and clear: he sees something on the horizon, and he's preparing for it. Are you? If you found this video insightful, make sure to like and subscribe for more expert investment analysis. Let us know in the comments, do you think a crash is coming, or is Buffett just being overly cautious? We'd love to hear your thoughts.